What is dividend imputation? Dividend imputation is a tax system designed to eliminate the double taxation of dividends, which occurs when corporations pay taxes on their profits and then shareholders pay taxes again on the dividends they receive. This approach acknowledges that dividends are a reward for shareholders, and the corporation has already paid taxes on these earnings. By providing investors with a tax credit, the imputation system addresses the issue of double taxation, allowing shareholders to reduce their taxable income by the amount of tax already paid by the corporation on their behalf. The primary objective of dividend imputation is to ensure that investors are not taxed twice on the same income. When companies distribute dividends, they have already fulfilled their tax obligations on those profits. Without an imputation system, investors would face additional taxation when reporting their dividend income on personal tax returns. The tax credit provided by the imputation system compensates for this, allowing shareholders to reduce their overall tax liability when they file their taxes. The calculation of imputation credits is straightforward. For instance, if a company distributes a $70 dividend and has a corporate tax rate of 30%, the investor would receive a franking or imputation credit of $30. Thus, the total income reported by the investor would be $100, $70 dividend plus $30 credit. However, the investor's marginal tax rate will determine whether they receive a refund or owe additional taxes. Introduced in Australia in 1987, the imputation system encourages investment in dividend-paying companies, particularly benefiting investors in lower tax brackets. By promoting long-term equity ownership, this system can lead to increased dividend payouts. Other nations, observing the effects of imputation credits, may consider similar policies to reduce or eliminate double taxation. However, it is important to note that investors may still face double taxation if their personal tax rate exceeds the corporate tax rate. For example, if both rates are set at 30%, there would be no additional tax burden on the investor. Conversely, if the personal rate is 40%, the investor would owe the difference, 10% in this case. Countries such as Australia, Canada, New Zealand, Chile, and Mexico utilize the dividend imputation system. While some nations have moved away from full imputation or adopted partial credits, supporters argue that maintaining this system is essential to encourage equity financing rather than debt financing. By reducing the tax burden on shareholders, companies may be more inclined to distribute profits as dividends, which can stimulate economic growth and prevent the accumulation of excess cash on corporate balance sheets.